Welcome to this Peters MacGregor update. I'm your host and Head of Research, Nathan Bell, and joining me today is our Senior Analyst, Trevor Scott. Welcome, Trevor.
Thank you.
The first slide there is, we've titled this presentation called Finding Value in World-Class Businesses. Don't worry from the picture there, we don't have all your money invested in South America. Today we'll run through a few of the usual items, and then we're going to look at a couple of off-the-radar ideas, which shows, I think, that while everyone's quite familiar with all the companies and the big US technology stocks, for example, are doing really well at the moment, there's actually a lot of value around the world in places that other people just aren't looking. So we've got a cycle that's potentially turning now with interest rates going up and quantitative easing lightening off. And from here, it's not going to be a case of just buying stocks and letting their multiples go up to make your returns. You're really going to need to buy businesses that can actually justify high valuations. And fortunately, as you look around the world, obviously the US is going very well, but it's not quite equal around the world. Europe's a bit of a laggard, and that's one area where we're finding opportunity. I'll just take the disclaimer as read. It's just worth reminding you what we're actually trying to do. So we've been around through many cycles now. We're a global equity manager, we're high conviction and we're value focused. And we've got alignment of staff, we're long only, bottom up, benchmark unaware, and we have low turnover and only looking for 20 to 30 holdings. And we aim to generate alpha over rolling 5-year periods and to do so differently. So while it's great to be different, you actually need to be right as well. There's two buckets that opportunities normally fall into for us. The first one is good businesses where the market is overly focused on recent bad news and over discounts this into share prices. So we're going to talk about a couple of examples later on in this presentation would fall into that bucket. And the second one is highly advantaged businesses whose growth potential is undervalued. So when you think about that, that's probably a good segue to Tencent, which is a Chinese technology stock that we bought for 35 times earnings. It's a very high multiple. It's not what you normally think of when you think of a value stock, but it's one that we think is undervalued and has performed extremely well for us in the very short period that we've owned it. But if you're trying to put our stock picks into two buckets of where we find opportunity, generally it falls into one of these buckets, and it's why we have some quite low growth businesses, which are your typical value stocks, but we also have some very fast growing businesses as well. In terms of our edge, the informational edge that you used to be able to get years ago, that's really gone now with the digital age. So we get our edge from being long term. We also look for complicated securities that the market tends to steer clear of. The market generally likes very simple stories, but often you can find a lot of value in complicated holding structures. It doesn't mean their products are difficult to understand, but they may be, but it's just more about pulling the holding company apart. And we've got a number of those in the portfolio. Spin-offs are something that we still look at. Being long-term is something that's becoming more valuable over time as the market becomes more short-term. And another thing that runs through our portfolio is we're generally looking for owner-managers, or at least the not corporate type of CEOs, but management that can really steer the business and add value even in tough markets. Now, I think when we've got valuations that are so high across the board, having management that can actually find opportunities to add value that don't fit easily into a spreadsheet is going to be worth its weight in gold. So the performance slide shows that the numbers don't look terrific. The 1 year there we're down 7%, and you might automatically think that we've had mistakes with our stocks, which actually hasn't been the case. It's mainly just because in the early period of last year, when the market was falling and the market had grave concerns about China, we had about 25 to 30% of the portfolio in cash. So we haven't really read that rebound out of that. So we've actually had a number of stocks that have almost doubled through that period. So there hasn't been any issue with the stock picking. It's just that we've been holding cash, and in a sense we've been too conservative. And that's actually the theme right through to those 3 years and 5 years and 7-year numbers. We did some navel gazing recently and ran a simulation with our portfolio management software, and we looked at what the returns would have been like over the past 5 years had we just had that cash invested in the same sort of weightings as the portfolio at the time. And basically it would have added another 4 to 5% annually over that 5-year period. So there's been absolutely no issues with the stock picking. It's just been the cash drag that we've had over that period. If you've been following the quarterlies over this year in particular, you will see that cash weighting has been coming down, and we've got a question from an advisor, and we'll talk about that at the end, which also reminds me, if you do want to submit questions, please do so now, and we'll answer them at the end of the presentation. But that simulation showed that underperformance is really only from the cash drag, so we haven't been getting full value for our stock picks. So throughout the year, as we've been finding more value outside of the US, the US is now on some measures the most highly valued it's ever been in history. But in places like Europe and China, that's simply not the case. So it's not a case where we've just been forced to invest the cash, but we've actually been doing slowly, and we've been finding opportunities to do that, and we're going to talk about a couple in detail soon. These are three areas that we've been finding value. Now, we are bottom-up stock pickers, so we buy our stocks one by one, but we do just happen to have three themes that are running through the portfolio at the moment. Just on the right-hand side, we'll first look at the European banks. We're going to talk about UBI shortly in a little bit of detail. But if you just look at the European banks as a sector, basically we're just following what we did in the US to Europe. And so we made good money out of Bank of America, for example, in the US, but you didn't really get full value for the stock pick until interest rates started to rise. And again, it just shows that short-term nature of the stock market. We were in there early and we waited for interest rates to rise, and then we got a fair value for the bank and we sold out. In the end, we sold out a bit too early. But we've basically played the same theme into Europe, which has been much slower to clean up its bad debts. ING, for example, when we bought it, was very cleaned up all its problems from the GFC, and was still trading at a bit over 1 times book value, and was offering a 4.5% dividend yield, which even an Australian wouldn't sneeze at. But for a very safe, top-notch bank, that was an extremely attractive price. Now, all the banks there are somewhat quite different, but in terms of the recovery story, the way to think about it is, I think it's the cheapest, sort of the safest time to buy European banks in at least 15 years. If I compare that to Australia, it's the riskiest time to buy Australian banks in nearly 3 decades. And you don't have to give up a lot on the dividends. Most of these businesses are very clean, and the bad debt problems are finally getting sorted out. And I'll give you an example about what's happening in Italy shortly. Trevor, I might hand over to Chinese technology stocks for a quick update.
Yeah, I'll just talk more broadly. One of the most interesting investment themes of the past couple of years has been those FANG stocks, the Facebooks, Amazon, Netflix, Googles of the world. And that's what's really pushed a huge amount of the outperformance in the US indexes. And trust me, we're doing a lot of work on those names. We're going through them. They're a huge component in terms of the weighting of the indexes. So we do spend time on it. And we think they're fabulous businesses with great CEOs. A lot of them are owner-operators. But the problem is, in terms of our investment process, it's the price we're paying to own them. We're just not able to make those numbers work. But again, we do recognize how fabulous those businesses are. And we're seeing those same businesses in China, but at much more attractive valuations. So the new companies that we've added, Baidu, JD, Tencent, they're completely analogous to the economics of the US business. So Baidu would be like Google, JD would be like Amazon, and Tencent is like Facebook. But in so many of these ways, these companies are far ahead of where the US businesses are. The easiest one to see would be Tencent with its WeChat. If you know anybody that lives in China or has gone to China even, what WeChat is like Facebook, but tenfold the importance. Everything is done in China on WeChat. And they really even haven't started to monetize the advertising story. There's so much just coming from online gaming. But the point is, we're still finding, if you just kind of broaden your investment horizons, we're global managers. We don't have to look in the US. We're finding those great companies that everybody's talking about, but much more attractive valuations.
We had a good set of numbers last night with JD after Singles Day. I think it's revenue growth of nearly 50% again, and I think that's the amazing thing about these businesses. Like Tencent is about $450 billion company growing revenues at 50%. These are just phenomenal economics that we've just never seen before. On the left-hand side there, just our cable TV and broadband internet providers. Some of those which we've owned for a while and have done very well for us. Some of them we've owned for a lot less time and haven't worked out yet. Telecom Italia is the bottom one, and Trevor's going to take you through that in detail shortly. But the main case here is that we just think it's unappreciated that the cables in the ground in other parts of the world, which operate quite different to Australia, they're basically monopoly businesses. You don't really have a choice who provides you broadband, and they're very hard to compete with because it's just exceptionally expensive to lay the cable in the ground. And despite new technologies coming along, like Google was trying to roll out fibre last year, they basically quit because it was just so expensive. So the intrinsic value in our view at the moment is higher than what the market's prepared to pay because too many investors and analysts are concerned about pay TV subscription losses, which have an incremental margin of about 35 to 40% for each customer. But for the broadband business, it's basically almost all profit when you add someone to the network because there's no content costs. You don't actually have to pay Disney for the content that they watch on the cable TV programs. And in a way, although we erred in not owning the FANG stocks, in a way we actually own the pipes that really facilitate those businesses. In a sense, these are actually infrastructure stocks. But the best thing about them is they're not highly regulated, so there's no limit on the price they can pay. And that's really where our contrarian view comes from, is that we think there's lots of pricing ability or the ability to lift prices over time in the broadband internet businesses. And even if they lose more cable TV subscribers than we think, we still think these businesses are going to be around and be much more profitable than they are today. So you can see on the portfolio changes slide, two of the stocks in terms of new additions we're going to speak about shortly. And the other company is Naspers. It's a South African company, which basically this is just another way to own Tencent at a much cheaper price. And if you want a few more details about that, just head to the recent quarterly. And you can see that we've exited a couple of stocks there too. I won't go into details about those today, but again, you can go to the quarterly and find out the reasons for that. So with that, I'll just spend a couple of minutes on UBI, which we think is a good example of a bank that's not particularly familiar out there, and it's one that looks exceptionally cheap to us as the Italian economy is recovering. So UBI is Italy's fifth largest bank, and what really got us interested about this company and the sector generally was around a year ago, UniCredit, which was one of Italy's largest banks, raised about 17 billion euros to help prepare its balance sheet and take care of the non-performing loans or bad debts. We then saw the similar thing in Germany where Deutsche Bank raised 8 billion euro, and that really got our attention that finally it looked like the sector or the banking sector across Europe was finally starting to get fixed up. Now, as it turned out, when we were looking across Italy and Europe for banks like ING, which is one we bought, UBI and another Italian bank called Intesa Sanpaolo were cherry picking the loans from a bunch of banks that, in a sense, were being euthanized by the Italian government. The ECB, or the European Central Bank, was telling Italy that they needed to clean up the banking system, and the Italian government put in 20 billion euro of taxpayer money to help get this sorted. So this company, UBI Banca and Intesa, were basically just cherry picking the loans from these banks that they were going to close, and all the bad debts went to the government, and the government's been on-selling those to hedge funds and other investors at 20 cents in the dollar, or 20 cents in the euro dollar. So what we've got here is these banks, basically when UBI did this deal, essentially the business was trading at about 3.5 billion euro as a market value, and it added around 1 billion euro just simply on this one deal. So the idea is that the investors think they're going to make money by taking all the bad debts and then collecting more money than the 20 cents in the dollar. And the banks like UBI, their balance sheets are going to improve over time as those bad debts continue to fall. And if you talk to anyone that's been travelling to Italy recently, finally, after many years, it's taken sort of 7-8 years, it's basically Italy and Greece and all of these other companies that we used to call part of the pigs. These have been basket case economies, and I don't think we really understand that these countries have actually been through depression-like situations where youth unemployment, for example, in Italy was around 50%, and that's now fallen into the 30%. So things are changing dramatically now. Finally, the economies are getting better, and we were able to buy UBI at 0.5 times tangible book value with a 3% dividend yield. And there's a picture of the CEO there, Victor Messiah, who interestingly actually worked at Westpac during the recovery years with Bob Joss in the early 90s. He believes the bank can achieve a return on equity of 10% over the next 2 or 3 years. Now, if you can get anywhere near that, then we expect this stock to double. But if you can achieve the 10% and interest rates start going up in across Europe, then there's no reason why this couldn't trade at 1.2 or 1.3 times book value. So we're a long way to go yet before we get there, but it just shows you the sort of value that's in the banking sector across Europe as opposed to the US and other places where the good news has already been factored into share prices. So with that, I'll hand over to Trevor.
Will Italians pay for high-speed internet? Okay, so this is a recent addition to our portfolio. It's one of our smaller positions as there's a bit of leverage in it, but it's very interesting and it follows on to the investment theme that we were following with Charter. So as Nathan said, when we went into Charter Communications through Liberty Broadband and Liberty Ventures, the analyst community was freaking out about TV subscriber losses. But what we saw was the consolidated results were actually going to improve due to the increase in broadband internet demand. And this is following a similar trend. First off, Italy has terrible internet. It's even worse than Australia. I'm coming from Canada, and the internet here seems like 20 years ago when I used to have a modem with dial-up. I don't want to say it's a joke, but it's a joke. And the whole point is Italy is even worse than Australia. What's happened with many European incumbent telcos is they were monopolies. The only way you got a home phone was to go through the national telco. And that worked really well until cell phones came out and they started dropping in price in the early 2000s. And all of a sudden, all of these Italian people did not have to deal with the monopoly Telecom Italia. So from the year 2000 to last year, nominal revenue declined by 40% for Telecom Italia, and we really wouldn't have paid much attention to the business until management changed with Vivendi, the French conglomerate, coming in 2 years ago. Now all of a sudden, the people that were going to leave, if you were going to leave your home phone, you've done it by now. Those subscriber losses are decreasing, and Telecom Italia is starting to near the end of a very comprehensive upgrade to its copper network, switching it to fiber. So by the end of 2019, 95% of their households passed, which is pretty much all of Italy, will finally have access to fiber. And we think that Italians, like many other countries, will happily pay more money if they have the option of getting faster internet speeds. So even today, Italy is still offering 4 and 5 megabit download speeds. That's even difficult to watch a basic low quality Netflix or YouTube subscription on. And that's the only option for so many Italians because, again, it's still mostly a monopoly. But the point is, this is changing now that the companies upgraded their network to fiber. They're not finished, but they have enough now. And the past 5 quarters, Telecom Italia has stopped the revenue losses and have actually started growing revenue. And when you look at the analyst forecast going out, the street still hasn't caught on to the fact that Telecom Italia is no longer a melting ice cube. It's actually a growing telecom company that is benefiting from the demand for broadband internet. So if you just take basic trends and have revenue start growing by 3%, and you have the CapEx, which is currently extremely high because of that reinvestment program, drop from 26% to the mid-teens by 2020, the amount of free cash flow that's going to be coming out of the business could be hitting 17 cents per share, which would mean the shares, if you're looking at the savings shares, which is what we own, are trading around 3 times free cash flow. So incredibly cheap numbers with high optionality that we think just has not been baked into the street's forecast. But overall, this is an investment that is banking that Italians will pay for higher internet like every other country has around the world once they have the availability to it.
And what's the importance of Vincent Bolloré in this investment case?
So Telecom Italia had a really weird board of directors before. Until recently, it was a bunch of Italian banks with Telefonica, the Spanish telephone conglomerate. And what's even stranger is Telecom Italia's second biggest market is Brazil, and their direct competitor in Brazil is Telefonica. So you have a very odd, conflicted CEO where his boss, the board of directors, is your direct competitor in Brazil. And it's just safe to say that there was massive conflicts of interest within the Telecom Italia management team. And that's now all gone because Vincent Bolloré, who's known as the Carl Icahn of Europe, has come in, taken control of the board, installed new management. And it's just after decades of not having a dedicated CEO that's looking after shareholders. They've just come to that level. So there's going to be a lot of low-hanging fruit, I feel, in terms of the operations.
So this is a good example of, while everyone's very much focused on what's driving the market today, these are the sort of opportunities we can uncover around the world, which we think offer very little risk of multiple compression, certainly when you're only paying is multiple of 3 times free cash flow, but also where the upside looks really high, based on research that we've done across this sector in other parts of the world. And again, it's also an example where when you're in the global space, you can take that learnings from one part of the world and apply it to other places and find more opportunities. So with that, I'll just hand over to Alex Haynes briefly, our Head of Distribution.
Thanks, Nathan. Before we go into question time, just to let everyone know that our strategy is rated by Zenith and Longsec. We're also widely available on all of the major platforms as well as the ASX M Fund service. If you're looking at that ASX M Fund service, would recommend Bell Direct. Bell, through their desktop broker system, is probably the best integrated software. And we also offer a individually managed account and a separately managed account program via Mason Stevens. So again, very happy to speak to anyone interested in accessing the strategy via those different portals. So with that, we'll now open up to any questions from the audience.
So the first question we've got is, do you have a comfortable cash position in your global equities fund? So the first thing I would say about that is, going back to the performance, is that holding a lot of cash has been a huge drag on our returns for a long time, and we've realised that's been a major mistake. And the question then becomes, is this really the time that you want to be putting that cash to work? But I hope particularly with the example of Telecom Italia and UBI, it just shows you that there are actually really, really undervalued businesses out there. And we think the portfolio looks as good today in a relative sense as it ever has. In the sense, it's probably not the cheapest portfolio that we've ever had, because obviously during a period like the GFC, your portfolio is going to be extremely cheap. But in terms of the way it looks, in terms of the geographic spread, in terms of quality of the businesses, and we've recently bought our first stock with Indian exposure. Over the last year or two, we've been increasing exposure to China. And again, we've got these couple of Italian companies which are just completely off the radar for most investors. So if we find those sort of opportunities and they fit our processes and we don't feel like we're reaching to add them to the portfolio in terms of the valuation, then we're going to buy them regardless of whatever the macro backdrop looks like. And I think that's a major mistake that a lot of investors make, is they try and predict the next big turn in the macro. And at the moment, it's almost a strange situation where valuations in the US, as I said, in some paradigms, they're the most expensive they've ever been. But at the same time, we've actually got a global economy now that's growing for about the first time, I think, in like 30 or 40 years, growing quickly all at the same time in a synchronized fashion. That just doesn't happen very often. So the fact that we're buying a bunch of laggards, I guess, around parts of Europe, actually fills us with a lot of confidence that our businesses are going to achieve their goals as laid out by management, their strategic goals. And when they do that, they'll get a fair value in the market. And we think the returns look pretty high for these sorts of businesses. So with that, we don't actually have any more questions. So as always, if you've got any questions, please don't hesitate to give us a call. And thanks very much for phoning in.
Thank you.